Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
And that's a pretty good guitar riff. Phil Tarrant, co-host of the Pure Property Podcast with Paul Glossop. Joining me in the studio is the one and only Paul Glossop. And I do note he couldn't even dress up and put a collared shirt on. He's come in a T-shirt.
This is Irish linen.
Well, that's what they actually used to put onto aeroplanes in the First World War was Irish linen. It's the best for your focker.
Fun fact.
Fun fact.
Another fun fact that I didn't ask for.
Why would I need to know that they use Irish linen on the wings of British World War One?
Tell me. Enlighten me. Enlighten me why.
Just one of those many facts that I know.
If you're looking to refurb a World War One
well,
bomber,
it still is really, really good for planes that don't have metal skins. They still use. No, well, maybe the moths and the mildew don't get into it. Maybe.
Yeah, maybe. Anyway, there we go. Thank you, though. Appreciate it. I'm sure everyone else is really appreciative of that.
But you got to know the facts. You need to know the details.
That's a good segue.
A lot of people say don't sweat the small stuff. You should sweat the small stuff, particularly when it comes to property investment. That's what I always say.
I like it.
That's why I always say do it yourself. Don't use a buyer's agent.
Yeah, fair enough. Why have you used one then?
Me?
Multiple times over.
Time, energy.
Do as I say,
effort.
not as I do.
Yeah, just don't want to deal with it. Just don't want to do it. I want someone who's better at it than me.
Yeah,
to be
fair
honest
enough.
with you,
I dare say your segue is that's not me.
God. I sometimes sit there and think, could I become a buyer's agent? And I go, maybe.
Right.
Maybe, but I don't want to. I don't want to.
Your patience maybe.
No, I sometimes find property quite fatiguing personally.
Yeah.
And
that's why you outsource it.
Yeah, exactly.
Yeah.
That's one of the reasons why I use it. I just don't want to have to deal with real estate agents, really. Like, I like real estate agents. I spend a lot of time with real estate agents, and I like property managers who manage my properties, but I don't like dealing with real estate agents when I'm buying property. I just don't want to.
The dance is a long one. I don't want to deal with it. It's a very long dance, and you've experienced this recently. I don't know from conversations we've had about a property you've been working on yourself, Phil, but it's trying. And as a buyer's agent for a long period of time, and having a team of buyer's agents within my company, I tell you what, it's not without its challenges.
Don't you get sick of it? Don't you just think, you must know all the games though, so you can shortcut it.
That's kind of it. Like there's a fair few hacks.
I'm not beating up real estate agents.
Not at all.
By the way.
Most of the good ones do their job, and part of their job is to really do the dance, and the dance takes time. It's not something you want to rush. If you want to maximise a price, and sometimes we're trying to not work with the best real estate agents intentionally to buy property. Selling property, different proposition. Buying property, we're trying to find the ones who want to do the dance on our terms, not on theirs.
Yeah, and most people don't like that.
No, vast majority.
And everyone's working towards the same outcome, which is a property transaction, but you're coming at it from two very different sides.
Completely.
The vendor, the agent, representative wants to get it as much money as possible, and you obviously want to get it at what you think is a good number, which often isn't the same number as what the seller wants to sell for.
Vast majority of the time.
Yeah.
And I guess that probably speaks volumes, and I know we're sort of not necessarily going on script here, but it probably speaks volumes for anyone who's proposing or considering engaging a buyer's agent. And we talk about a lot of this really early when we were trying to shape the industry, Phil, on not this podcast, but your podcast network on SPI, when you're sort of talking about what buyer's agents do. That conversations happen more times than we care to talk about. But how buyer's agents are incentivized is also part of the questions that you need to sort of understand. Is that when you talked about both of their intentions, one's to get the price as high as possible, the other one's to get the price as low as possible. If you're charging a flat fee for us, that's why we don't want to get the dance done at the highest price possible, because ultimately we're not incentivized on a price or a commission based on a sale price. We're incentivized to get an outcome that we know is the best outcome possible.
It's a hard one when you're... I know people do it on principal place of residence, right? And normally that's okay because there's sort of a set budget in place. You're not going to get a huge surprise. But if you're buying investment property over market value and you're actually paying someone to do that, like, and it happens.
Yeah, a lot.
It happens.
And
that
unfortunately
pisses people off, right?
Yeah.
And I see it time and time again and we just did some research actually on this. You go and look at it in Smart Property Investment, but pretty much saying how many people who'd use the buyer's agent the first time and then don't want to use a buyer's agent for the second time. And the numbers are quite sort of interesting. And I think the reason why, and we've got a shared friend who I talked to, I won't give any information around them, who I think used you for buying a property or two and then
bought a couple.
I don't want to pay Paul no more. I'll do it myself.
Yep.
And I was like, sure. Knock yourself out, mate. He doesn't care. Like if you use him, he's going to do a good job.
Yep.
But if you want to try and do it yourself, no worries.
Yep.
Knock your socks off.
Yep.
Which is like,
yeah.
Then I think he spent like 6 months trying to do it and he would stuff it.
Yeah.
And he'd come back
and there we were again.
And
that's
I don't know if
probably
he
done
tunes
really
into this.
well.
Yeah, I bet you they have. But, but it's funny how it works.
Yeah.
When people just work out, it's just not the buying bit, it's everything else.
Everything else.
Yep. Or they go,
Yeah.
Paul's told me where I should buy. I'm going to go buy there by myself.
Absolutely. And a hot tip, we don't ring fence that information. If you're going to come and have a chat with me, an initial chat, and you're going to tell me your situation, you're going to tell me what you want to do, or we're going to talk about building a strategy and a plan, the locations and the property types aren't something that I'm going to say you pay me first before I'll tell you that. All of that information is something that we intentionally want to give away because we don't feel like we're the gatekeepers of random suburbs which no one else knows exist. This is all public information. The job is the execution. 90% of what we do is the execution.
Yeah.
Yep.
Yeah, and sort of having spent a lot of time with and around and working with buyers agents, if you're not using, and I think this is the person we're speaking about, pretty much going because he go, I don't know what buyer's agent really do and this that, and the other. By the time a property lands on realestate.com, it's probably gone through the hands of about 4 or 5 buyer's agents anyway.
Yep.
And that's the reason why it's probably on realestate.com is because the agent couldn't shift it before it actually went onto the market. So if it's there already, I think we've used this Chinook salmon before. It's probably still a good property, but it's been rejected by John West, right?
It has.
So anyway, just give some logic to it.
Words of the wise.
Buyer's agents. Anyway, well, you got your own podcast now.
I do. Well, I thought it was something that we looked at.
This is your podcast, by the way.
This is my
nothing
podcast.
to do with me.
It's not yours. You're here for begrudgingly for some reason that people like your voice potentially more than mine. But we might have to poll that just to figure that one out. But I am told I know I'm quite nasally. It's not my fault. It's the way God's built me and developed me. I could get maybe a little deviated septum clearing out there maybe. But look, I'm not ill. I don't suffer from a permanent cold. I'm just nasally. But that being said, I think what we've chosen to do with this podcast and what we're going to do again today is pick real life, both clients of mine, but just general property investors from all walks of life, all times that they're intersecting or choosing to invest or choosing not to invest, and they all have an interesting story to tell. And I think really the intention here is that we're not talking theory, we're talking relative outcomes for people at different stages of their investing career, and we're showing real life examples of good and not so good things that have happened and where they've invested, what they could have done differently, and hopefully giving a lot of people real life stories as to what they can learn from.
Yeah, and that's the logic of this, try and do things a bit different. Reaction videos is what people want. So I have here, they've given me a little computer for those people who can see on the video here where I get to press stop and start. So I have no idea what's on this. So
you don't?
No, I actually have no idea. I know it's Chloe. Hey Chloe, how you going? And if you're watching this on video, you'll be able to watch this as well. Or if you're on the on audio, you should get the sense of it all. But essentially, we've got a bit of a recording that Paul has had with Chloe. It's probably like akin to a catch-up or some sort of consultation type thing.
Like basically part of our annual reviews, going through it and having that in-depth discussion about where, what, how, why, and going through all those warts and all components that we do go through with our clients.
Thanks for doing this, Chloe. It's appreciative. Is there anything I need to know beforehand? Do we need to know anything about Chloe? You cover it all off? Or?
Look, we'll cover it off, but I guess just to set the scene for everyone who's listening in, Chloe and her husband Joel came to us probably the best part of 3-4 years ago, or maybe 3 years ago now from memory. At that time, they had their principal place of residence they bought 4 or 5 years prior. They're both working couple, have bought a home in the western suburbs of Sydney some time before catching up with us. They also had then bought a property in Mudgee, which they bought without our services at the time. It's done well, but I think the intention of buying that property then for there was something they could see, something they could renovate, something they could get their hands on and touch. And then they essentially pushed pause and did nothing. And I think what for me, and we'll touch base on this a little bit later in this podcast, but I think what they're a true testament of is that most people listening to this are probably in a position where they either can or want to do something. There's always going to be a crossroads and a choice for anyone out there who thinks it's too hard basket, or it's too late, or it's too early, or it's not the right time. They are testament to a scenario where there's never going to be a perfect time. They had a young family. They've continued to grow their family. They both have busy careers. Things happen in life. And what they've done consistently is continue to take steps to better their financial future. And I think for anyone who's out there thinking, look, they're mid-30s, mid to late 30s, they're at the peak age of continuing to grow a family, be super busy, and all those things that come with raising a young family. They could have just chosen to say, look, we'll do this in 10 years' time. Yep. But I guess what the cost of doing that is we'll find out in this podcast.
All right, well, let's start the recording. I'll press the go button.
G'day, Chloe. Thanks again for joining us. And I know
Glossop
that
talking,
based on what we've discussed on air, and obviously what we're going to discuss on air, this is going to be, for hopefully all listeners, a really, really interesting cross-section of information that we don't necessarily get a chance to talk about on property investment podcast networks such as ours. Is that there's certainly going to be a bit more flavour in a comparison of shares versus property, and real-life example of that, and real life experience, and probably internet connection. I think from what I know, and hopefully we'll get a lot more information out of this as part of our chat, is that it doesn't have to be completely and utterly ubiquitous to say that you either are a property investor or a share investor. You can't be in both camps. So for everyone out there, Chloe and your partner Joel have been clients of ours for the best part of probably 2.5 years, maybe coming on 3 years now. And I think we initially had some conversations, probably the best part.
Is that a ficus plant in the background? Or is it real or fake?
It's real. I water that thing every other day.
Really?
Yep. It's happy.
It's very green, isn't it?
It is very green.
Yeah, okay,
Thank you.
Yeah.
Part of 2.5, 3 years ago to talk about the position we're in and setting up a bit more of a longer-term property performance portfolio focused on growth, focused on cash flow. You weren't starting fresh when you came to us. You did have property. You also had a substantial share portfolio. And we're sort of looking at, okay, how do we really get this onto a level that we know is going to give us really meaningful returns? So for the listeners out there, Chloe, hopefully from what I'd like to maybe open with is throwing it over to yourself to get a bit more of an understanding as to yourself, your partner, where you are in life, when you joined us, what your portfolio looked like both on the property and share market side a couple of years ago before we started to build the property portfolio side, and we can hopefully dig a bit deeper from there.
Yeah, sure. Well, thanks for having me.
That's a long introduction. I mean, taking... Right, so it's all set up. That's all good.
The scene. We like to set the scene.
Set. Yeah, it's cool. It's good.
Me, Paul. Very happy to be on the show, on the podcast. Look, we first, I think, stumbled across your podcast in 2021. And as you mentioned, at that stage, we had already started dabbling. And I say dabbling because it was a little bit of luck at the start. And we were really trying to upskill and build our knowledge in the property investment side. So at that point in time, we had our own place. We worked hard and saved our deposit. There definitely wasn't any, I suppose, any real financial help from parents or relatives or anything like that. So we saved hard, and we had one child at the time. We wanted to get into property investment, and because of our credit limitations at that time, we were really looking around the regional sectors, and which is an interesting insight. So we were kind of boxed into the region. So we wanted to find a regional centre that we could see ourselves visiting, really. Mm-hmm. So we settled on Mudgee, and we bought in, I suppose, the eastern suburbs side of Mudgee. So we went up on a few weekends, and we saw this property we fell absolutely in love with, and it was just a 2-bedroom 1800s property in the centre of town. So we bought that for about $355,000 about 6 or 7 years ago.
Yep.
And look, during COVID, obviously, we all know a lot of those tourist towns, those regional towns went boom. So we've actually moved that to an Airbnb type arrangement now, and it still is performing great for us, and it brings in circa about $3,000 a month for us, which is really good. When we called you, I actually Joel and I thought we've got to do more. You know, we're striving for financial freedom and hopefully an earlier retirement. We need to do more with our money. You can't just sit there. You can't keep spending it. So, and I fell pregnant at that time as well. So I had an impending maternity leave coming up. So I think we contacted you in 2021 to talk about our next strategy. And I think for us, we spent a lot of time trying to do a lot of our own research. And I think it was great reaching out to you because you made sense of all that research for us and provided your own perspective. And we reached out to quite a few people, and your approach really resonated with us. So I think you guided us into more of our next property, a set and forget property up in Rothwell. At that same time is when we thought we have to really diversify as well and do more in the share market. So to be honest, we weren't as comfortable with shares. So we went for a bit of a conservative approach, and we went for managed funds through Macquarie Group, actually. So we put some substantial shareholdings in an Australian share fund at that point in time.
I'll stop it there really quickly, Paul. So this is the story of property and shares simultaneously. And I'm sitting there going, I wonder how the share portfolio is gone. And I'm not going to express what I think has happened. And I'll see how that all plays out. But a couple of key points there. Number one, why did they think they needed to also invest in shares as well as property? Do they have a financial planner?
No, they didn't. But I think the one word that gets thrown around, I personally, the older I get, the more I realise that the word diversification is probably a safety word for a lot of people. And I think ultimately people think that if they're early in the stage in investing, they think, well, one might do better than the other, or ultimately I need a safety net in the share market if the property market, or vice versa. I think their position was, okay, well, we need to get some money into some managed funds. Chloe, and she might correct me off air if I'm wrong here, but I think did work with Macquarie at the time. So probably had a little bit of that head office mentality. Yeah,
just the influence of the environment.
Which is closest people. Which exactly that. And we did speak off air about this. We don't actually go too deep in the performance of the shares, but suffice to say, Phil, that your assumptions are somewhat correct in that she put money into, or her and Joel put money into managed funds, predominantly ASX managed funds. The growth of those properties, the growth of that fund in general has been modest to say the least. And probably her resounding observation of Australian shares in general from what she's seen in the returns has been more that they're geared towards dividends as opposed to growth. And I think that's where her mindset has shifted. And I'm not opposed to it. And you and I, we talk about this all the time, that we've got money invested in shares and other things that we don't necessarily know that much about. But when it comes down to it, it was for the feeling of safety, because my money's a bit diversified. It's not just all in one market or one product.
That's cool. And I can't criticise that. It's and managed funds, for those of you who aren't familiar with it, essentially someone else sort of goes out there and works out what funds to invest in. So then you take a position at the aggregate level of a little bit of this, that, the other, and the idea being that some of, if it's Australian equities, some of them will outperform the market, some of them will perform as per the market, and some of them will perform less than how the market performs. But at an aggregate level, you're hoping that you're going to get some sort of performance and therefore get a check out of it, yield, so income. And you find that a lot of people will look at those type of investments when they move from sort of accumulation to consolidation and then sort of a retirement phase where they start thinking about how you can generate money. Like, it's great as a property investor to get a lot of capital growth as you're going. you can't spend capital growth unless you do something about it, and it takes time and it costs money to trade in and out of property.
Yeah, and I think one last thing I'll add to that before we continue on with this, and you'll probably note that one thing we talk about a fair bit, and when I do set up strategies with clients, we talk about buffers, and buffers are more or less, and we talked about this with another friend off air, Phil, is that buffers aren't necessarily your savings that sit in a bank account. That is one form of a buffer, but another buffer essentially is shares that could be liquidated pretty much immediately if you needed that cash at a squeeze for a particular reason. Yeah. It could also be you've refinanced a property that's grown in value and released equity with no intention to touch that, but the money's available if something goes wrong. And there has been an actual scenario about building a portfolio, which we go into here, and I won't give it away, but buffers are key. And the share market and having those managed funds was also that methodology of that's where a buffer sat. It didn't just sit dormant in a cash account earning nothing. It actually tried to get some money out of it, but it also meant that we've got money to draw on if we do need it at a pinch. Yeah,
she spoke about tracking you down from a podcast. Was that what the smart property investment show?
Unfortunately, yes.
That's got to annoy you. But she says she spoke to other buyers agents as well, though. So you're normally part of a competitive tender, I guess.
It certainly is. I mean, I get interviewed on that first meeting that I have with almost all of my clients. I take it in the sense
that you have a job interview pretty much every day of the week.
I have about 10 a day. Yeah. And I mean, the beauty about doing it regularly.
What's your conversion rate? 1 in 10.
Well, it depends on the day. Yeah. But ultimately what it means is, I mean, you do this enough. I mean, our figures are our figures. I mean, we've done our Fast 50 guide recently. We've done our Fast 50 guide at the start of this year. We're going to release another one next year. We talk about the results, and we've been in this game for a decade, and we've bought 2,000 properties. So we actually have a lot of data that we can retrace on how we've bought, where we've bought, how it's performed versus the market. So, ideally, from this point in time, our reputation precedes us. So if people are going to interview me, it's not necessarily just on what performance they're going to get. It's also, can they work with me? Am I the person that they get along with? Is my team going to be the right fit? Because as you know, Phil, this is investment in the person and the company as much as the outcomes they're going to deliver.
Yeah, and you're absolutely right. We've spoken about that beforehand. You can tune in some of those podcasts. Just one more thing before we continue. Chloe said, we fell in love with the property. Does that make you nervous as a property investment guy?
Most of the time, yes. Yeah. Most of the time, it usually correlates to underperformance.
We fell in love with the property. It was the 1890s or something.
Yeah, cottage.
Old.
Yeah, old and needing some love. But in turn, where they did end up buying, and she mentioned the word luck a few times in this conversation, she said they lucked out. And to be fair, they did. But they bought within, they knew their budget, they knew what they needed for that first purchase, and it worked out well for them.
And the Airbnb type scenario works? Is that onerous in terms of management for them?
I think it probably the juice is worth the squeeze for the time being. Yeah. But it sounds like it's okay because the property doesn't need a huge amount of work. It's a relatively small. I think it's a 2-bedroom cottage. Okay. It doesn't need a lot of work. It's not a huge clean-up job. In the middle of town, it's typically going to be adults, not a sort of a big Airbnb with pools and kids and things that can break and all those types of things. Very, very simple.
So romantic getaways to Mudgee for the wine tasting.
Yeah, you go do wine tasting, go out for a meal, you use it for a night or two, and then you're gone, and it's probably vacant during the week.
Okay, here we go.
And obviously we also had some other shares, but again, we just went with share companies that we buy into ourselves. That was our only reasoning.
Yeah. Yeah, well, it's so I guess it's the jump back before you bought your property in Mudgee, your first investment in Mudgee. You had your principal place of residence at that time,
That's
correct?
Right.
And you'd grafted, you'd saved, and that was essentially buying that home to say, look, we've got our foothold. The Mudgee property, correct me if I'm wrong, but you used equity from your home to buy that first investment.
Yes.
And then when we got to the point of us having our discussion in 2021 was obviously some years after you bought Mudgee. What was the structure of where the funds and the finance was going to come from?
Yeah, look, at that point, again, we're still learning. So the broker, we've changed brokers since, actually did do an equity release, but collateral really with our principal place of residence, which we know, we don't want to do. So that's because we didn't know better at that time, Paul, that was what we were guided on, and we decided to go with to get that Mudgee property. Thank goodness, and I think everywhere in Australia did grow in value. We're in a good position to then, we soon realised that wasn't the right move as we continued to build our knowledge, and we reached out to another broker that was more property investment savvy. I suppose we really untangled that web for us.
Yeah, very much so. And I think it's certainly not an uncommon scenario that plays out in that, especially in that first investment. Is that, and I'll probably defend not necessarily knowing the details of it at the time, but I know there's typically can be a time and a place for cross securitization. Of whether it's two investment properties together, or your home plus an investment, or multiple investments for that matter. However, a lot of the time it is done because it is very, very easy. It's a lot less paperwork. It's a lot more seamless, and ultimately, for the broker or bank, it does make the client a lot more sticky over the long term. So selfishly, they can make a lot more money by doing a lot less if they do go down that pathway. So I think word to the wise for anyone listening: if a cross securitization of securities, essentially as part of an investment strategy, funding strategy, is proposed by your broker, I wouldn't be running the other way necessarily, but I'd certainly ask the question as to how does this relate different to me extracting equity from a property or using equity in a property to then fund a separate investment with a separate standalone opportunity as far as loan structure, and maybe ask the question, is it possible? And if it is, why are we going down the cross securitization pathway as opposed to having standalone debts? Because I guess to go back for fundamental aspects for anyone listening who maybe not necessarily grasping onto the concept is, if your properties are linked, and let's say we go after your principal place of residence and your Mudgee property, if COVID went the other way, which we all remember that there was some pretty big economists out there talking about 30, 40, 50% reductions in property prices immediately when that kicked in. If Mudgee went that way, and all of a sudden you bought it for mid threes and you had a debt of circa 350 on the property, and it went down to 250, technically you're in negative equity, and you can't sell that property without necessarily having to sell your own principal place of residence, because ultimately they're all linked. And if there's negative equity, then all of a sudden you run into much larger issues with your entire asset base. Whereas if they were delinked and Mudgee was standalone and it went down in value, yes, you might technically have sold it at a loss, but that doesn't mean it affects necessarily your actual principal place of residence debt. So there's obviously some benefits. There's definitely some hindrances if not done correctly. And I think it's a matter of going into those situations with eyes wide open, as opposed to sort of just listening and agreeing with the broker without questioning their experience.
And that's right. And I think for us, we were a little bit ignorant at that time, and we put a bit too much trust in the broker at that point. And I'm sure they are a stand-up person, no doubt. But we definitely could have gone down the route of not having to have that cross securitization. So it was messier to untangle for our next purchase, and it just wasn't the right move to start. So a lesson learned, and a good one.
Yeah.
So whether it's this lesson or any other lesson, you got to make sure you learn from your lessons. And hindsight's a wonderful thing. But I hear this a lot with newer investors. They often don't get the right advice when it comes to loan structuring. And there's a lot of really good mortgage brokers out there. However, some mortgage brokers and maybe a lot of mortgage brokers, depending on how you frame it, are very good at doing sort of owner-occupier stuff. And they might not be as comfortable operating in the investor space, particularly if you're a property investor looking to grow a large property portfolio. And if you get your structure wrong at the front end, let me tell you, it's really, really, really hard to unravel as you go down through that pathway. And having sort of knocked around mortgage broker for quite some time, a lot of really good brokers' work is untangling people's structure before they can start doing anything else. You must get a lot with your clients where you just go, I can't borrow any more money, and that's why. And a lot of people invest in trusts because there's different, ways in which lenders view your trusts. They can view them independently. If your trusts, I'm not giving financial advice here by any means, but if your trusts are neutrally geared, often they won't even consider the debt in those trusts as part of your whole serviceability. So, if you're cross-collateralised, for some people it's the only choice, the only option, but it does have some limiting factors around it. So I think you cover that quite a lot. But ask a question like Chloe's done there. Yes, I'm sure the broker is really, really good, but, and often your main banks will say they'll want you to cross-collateralise, because if you're cross-collateralised, it's very hard to refinance.
Yeah.
Because you need to refinance everything.
You're very sticky.
Yeah, very sticky customer, and particularly when rates go up and people sit there and just go, I want to refinance, and they go, I can't get it anywhere else, so you're stuck, right?
Yeah.
Then anyway.
Yeah. Yeah, that's. I think, mate, you've wrapped it up nicely.
Yeah, yeah. All right, let's continue.
Absolutely, and I think, look, the reality is you've got that all sorted and on the right track now. So essentially, everything that's purchased subsequently is going to be correct structures. You obviously are far more knowledgeable as you go, and you build all these little tips and tricks along the way. So if we, I guess, fast forward again back to that 2021 timeframe, we had that discussion. We talked about the strategy. We talked about the fact that we wanted to use what we had to continue to build up those building blocks. And that's where we landed on North Brisbane as an option. We had a budget of circa sort of mid-5s, high-5s, mid-6s at sort of in that region. And we were focusing on wanting to acquire a growth asset, which was still going to give us some decent cash flow, but certainly a long-term buy and hold play. So from memory, I think we landed on a property in Rothwell, which, for anyone who's listening who's not familiar, it's probably circa 30, 35 minutes from the Brisbane CBD, about 10 minutes from the Moreton Bay coastline, on a new train line, access to a bunch of amenity in there. Probably was considered a very affordable corridor while still being quite well built out. There wasn't a huge amount of available supply back then. We bought that property for $590 from memory, somewhere around about that price point.
Yes, yeah.
And obviously interest rates were a lot cheaper when we bought that property. So rent, I think, was low to mid-5s when we first bought the property. Has that increased since?
When we first bought it, it actually was in the more in the 4s. But we had negotiated before we bought it, and I think you also helped us a bit with this, Paul. We had definitely tested the waters because it hadn't had a rise for some time, and it was quite under market. So it's in the mid 5s now. Yeah, and we're still got the same great tenants.
Yeah, perfect. And I think that was a bit of a lesson, is that whilst the property is probably circa 5% gross yield at the moment, which is not exceptionally high for gross yield standards for residential property, nor is it terribly low. I think there's a good lesson that property was bought with an existing tenant. That tenant had been looked after by the previous owner, which unfortunately a lot of the time when you hear people saying they're a fantastic tenant, legacy tenants, whilst they can look after a property and obviously they give you continuity of rent, there's a bit of a fine balance between thinking, okay, how much do I look after them from a rent perspective versus how much are they saving me from upkeep, maintenance, turnover of tenants, etc. And I think you've got to run a bit of a fine line to be fair, but you've also got to be reasonable in the sense that you're running a business with this property, and obviously you need to keep it into that line. So when we did negotiate that property, we were aware that A, they were on a periodic lease, B, their lease and their rent amount was well and truly below market value. So it wasn't unfair to bring it to probably somewhere midway around market value. It's not going to be gouging them from a rental perspective, but it brings it to a standard where you can consistently keep it on that lineage and that trajectory. Because back then when we bought the property, interest rates in the 2s, having a property under rented by $50, $80, $100 a week wasn't a big deal because it was still cash flow neutral. Obviously, fast forwarding with 14 interest rate rises and here where we are now at a 4.35% cash rate, that's a much different proposition for people to realise that, hey, landlords are business owners and they have costs that fluctuate without any of their control, and obviously keeping rents up becomes a lot more important. But
so that's another comment, like we fell in love with the property when people go, oh yeah, I got great tenants, they're really, really nice.
But I mean, look,
they've been there for 10 years.
Yeah, I default that all my tenants are great people, to be honest with you. I mean, I don't assume people are sinister and have an ulterior motive because of what they're doing in my property or clients' properties, etc. But I mean, I guess to my point in that clip there with Chloe is that there's you got to strike a balance, and you there's going to be good times and not so good times from a cash flow standpoint for most property investment owners. You've got to be realistic, and the biggest risk that most people fall in line with is that if the tenants are great and they don't ask for much and they keep the property in great condition, look, I think there's a fine balance of looking after them, but looking after them doesn't mean not looking after yourself. And when it comes down to not looking after yourself, if you can't afford to hold the property and all of a sudden is two things, either A, you have to sell it at a pinch, or B, more likely you have to give them a much larger rent rise, they're not going to like that. And ultimately they're probably going to leave, or they might find issues and then they might push back to you, and then you might end up finding yourself in in tribunal or something else that comes with that as well. So there's a balance. There's always a balance you've got to find.
What do you reckon of people on month-on-month rents? Do you like people on leases, or are you okay with month-on-month?
I think when I probably prefer, if I'm honest, if we're buying property with a legacy tenant. When I say a legacy tenant, you're buying a property that's already tenanted. You didn't choose the tenant, so the tenant comes with the property. If they're on a periodic when we buy the property, as opposed to signing them up before we settle on a new 12-month lease at a particular point and price point. We do a few things. We always try to review the tenant ledger, so at least the last 12 months of their payments to figure out, are they regular before we've actually committed to that tenant. And we also, obviously, we want to see an ingoing condition report of what the property was when the tenant went in there. So we try to get that information before we actually even recommend a property to our clients. So we know, hey, we've got this property here, that here's the condition of it now. Here's the condition or entry condition report when this tenant moved in. And we know that essentially they're paying their bills on time, or they're paying their rent on time. We can see the condition of the property, say 3 years ago when they moved in. Here's the condition of the property based on the photos and the walkthrough now. We can see that they're keeping the property in pretty good condition. So we would then in that instance say, let's throw them another long lease at market rate because we know they're good. Alternatively, it might say, hey, they were a little bit slow and back and forth here in COVID times. They keep the property pretty average. The lawns are overgrown. They don't seem to really care too much about it. I'd keep them on a periodic for a period of time, assess, probably try to get them in line, both with keeping the property at a condition that you're comfortable with, as well as seeing if they're actually paying their rent when they should, how they should regularly. If they're not, then that obviously gives you an option to potentially give them a vacate notice, depending on where and what you've bought, and obviously the state regulation.
Yeah, and say, for example, if you're in New South Wales, if you're on a periodic lease, it's 90 days. So
correct.
90 days, So you've got
to vacate.
So you get them 90 days notice.
Yeah, which is fair and reasonable in my opinion. 90 days, if someone's given a 90-day notice, if you're given 90-day notice today, Phil, and then ultimately, you've got no alternative to renew the lease, then you're like, okay, well, that's 3 months. I guess I'll start looking for a property this weekend. Yeah. And that's where it starts, and that's enough time. You're not kicking them out in 2 weeks. You're giving them ample time to find accommodation.
And if someone's in a lease, you can't break the lease.
Correct.
Yeah. But you can choose not to renew the lease.
Exactly.
So at the end of the term, you just go, there's no renewal.
Exactly.
So if they go, I want to stay here, then you can have a commercial negotiation with them.
Exactly. Yeah. And you typically want to do that well before the lease is up for renewal as well.
Yeah, and most places you've got to give 60 days notice.
30 to 60 days, depending on the state and territory you're buying in.
Jack up the...
either jack up the rent or new 12-month, new 6-month lease, any other conditions. A lot of time, one big note as well for anyone who's got legacy tenants, let's say 3, 4, 5, 10 years in the same property. One thing to always remember too is that if you're buying a property that the tenant's been there for a very long period of time, the likelihood is that their bond is extremely low as well. Yeah. So you got to remember the bond's typically 4 weeks rent. And if they were renting the property 10 years ago or even 5 years ago at a rate that was very low or low comparatively to what it is today, there's probably very little amount of money you can claim if they're an average tenant.
Can you do a rent top-up? A bond top-up?
You can. You definitely can. You can request it as part of a new lease negotiation to say, look, I'm happy for you to sign on to a new lease at X for 12 months, but part of the conditions of that is I want the bond to go to current rents as well, because that's a protection for you as an investor and as a landlord.
What's the nitty-gritty? Let's get back to Chloe.
More importantly, that property was obviously not bought to get a cash flow play immediately. Your Mudgee property, different proposition. You bought it, and obviously that was a lifestyle play. It was a property that was now being switched to an Airbnb, and obviously the beauty of that is you've also held it for a longer period of time. It's seeing good growth, good cash flow. The Rothwell property value now, from what I can see, is probably around that early to mid sevens. So I'd probably say it's circa 20-25% growth on where it was purchased in a bit less than 2 years ago, or somewhere around about 2 years ago. And I think what we landed on then was saying, okay, great, we've now got exposure in New South Wales, you've got your principal place of residence in Sydney, you've got a bit of diversification into the share market. That'll remain. However, we're now exposed in the Brisbane market, looking at that as a 10-year play. And then what we ended up doing, I think we caught up, it might have been early 2023 from memory, which then led to the next conversation, which I'll maybe throw to you to sort of give the audience a bit more understanding as to, okay, well, we saw a bit of growth. We wanted to continue to move forward. What did we do at that time? Pending, obviously, also taking into consideration, you had a young family, life was chaotic, life still probably no doubt is chaotic, but you had the ambition and demand to keep going.
Yeah, and definitely, life is chaotic, but we do have that end vision, I suppose, in mind at all times. And I think with that in mind, we're aiming for a bit more of an earlier retirement. So we did want to make another play, and we reached out again, and we did our own research, as we like to do as well. And we settled on diversifying into the Perth market. You helped us out there. And I think one of the fundamentals for us that we like to do also is to keep that land to building ratio quite generous. So both our properties do have, a close to 600 to 700 type square metre properties, and we know that the land appreciates over time. And that was the same for the property that you found us in Perth. And we, I think that Koodanup is where we landed there. And we quite a low purchase price. I didn't even know we had houses available for 380 for that property. So, so that was an easy move for us, because we're able to again leverage the equity in the Mudgee property to
absolutely.
make that
and
move.
I think the beauty about that, and this is probably a good lesson for anyone listening, to say, well, you haven't built this portfolio in a month, in a year, or even 2 or 3 years. You haven't necessarily got lucky because of COVID. What you've done is you've essentially bought your principal place of residence when you could. You worked hard, saved the deposit, got your borrowing capacity up, kept your income strong, kept growing your incomes as and when you could within your jobs. Use that to then leverage into a property. That property grew in value. You could have essentially at that point in time done nothing. And if we rewind sort of 6, 7, 8 years before you even bought Mudgee, the scenario there could have been pretty straightforward to say, you know what, let's raise a family and let's be happy and let's pay off our home, and then let's hope that super is going to fulfill our retirement. What you've essentially done rather early in your careers is sort of made a decision. We'll say, well, we will be paying into our super. We don't intend to stop working. Our super will be what it'll be, regardless of whether we choose to get more aggressive and work harder and maybe take some additional risk, push the envelope a little bit more than what others might not be prepared to do. But that led to obviously extracting some of that equity from that home, buying Mudgee.
So I reckon Chloe's story is probably more consistent with most property investors than what you would be led to believe by listening to podcasts and stories that you might read in, like these hyper strategic people.
Yeah.
You know, like, yes, I'm going to do like, and if you sort of get property stuff into your feeds on your social media, you would think that everyone is a shrewd strategic property investor.
No.
Where most people are just making it up as they go along with time on their side.
Yeah.
And probably not making it up as go along, but just sort of like there's a degree of patience and a degree of pragmatism, which absolutely sounds like Chloe's story. It's not like they haven't set out and aggressively followed some strategic path. Some people do that, but most don't.
And the reason why most don't, I believe, Phil, is that we catch up with hundreds and hundreds of our existing clients every single year. And I'm not going to go to every single client when I do a review of their portfolio and say it's grown by 8.3%, just like we said it was going to in 2021. Essentially, we review and figure out, is there capacity? Has your income changed? Has your life changed? Has your expenditure changed? Have interest rates changed? Have your rents changed? All these inputs are going to change. And ultimately, if the answer is, hey, we're going to continue to stay the course for the time being, then we stay the course. And then we catch up again the next year. And then at some point in time, it might be, hey, there's enough equity, there's borrowing capacity, you've got the desire, you know that if you do nothing, you're on this course. If you do something more, you're probably on this course. That's a very real way. To your point, that's what most, I believe, not only property investors, but successful property investors, that's typically how they flow through it.
Yeah, in 20 time they go, wow, how did that happen? I just didn't realise that, But the point I want to make is that it's okay if you're not a hyper-aggressive, spending every minute of every day planning and thinking and being strategically orientated around your property portfolio. It's okay just to, buy good properties.
Yeah.
Your strategy might be, I'm going to buy good properties and hold them long term and try and make sure that they don't cost me too much money to hold over that period of time. That's okay.
That's a playbook in itself.
That's okay. That's enough. That's the strategy you need, right?
That's a strategy.
And it doesn't need to be, do this, that. So it's okay. It's okay for the other way as well. If you want to be super engaged and, I want to get 4 properties in the first year and then 3 properties the next, and every moment is built around your property portfolio. No, I'm not going to go to that party because I'm going to have to buy Voggers and Coke and I don't want to spend $100
that's
on
where
that,
the challenges lie, I think, when people are in that point where they're doing their algorithm for every single dollar and cent, that the P&L is their life. And it just becomes, for me, that becomes probably something that is not sustainable. And that's where most people, I find, probably just get out of it because all of a sudden something happens and they have to throw the baby over the bathwater.
I'm sure someone else will use this at some point in time, but property investment is like dieting, right? You can count your calories and you can weigh every single bit of chicken breast and cut it up and make sure it's perfect to a gram, and you can do 14 protein shakes and 1 egg and this, that and the other. Like some people hyper focused and hyper aggressive when it comes to their food intake on the basis of their dieting plan, whereas other people just go, you know what? I'm just not going to eat breakfast anymore.
Just cut that out.
I'm just going to remove
cut those
breakfast,
calories out.
and it's just one thing, and it's pretty easy to do. You just go, I'm just going to eat breakfast anymore.
Yeah.
I'll have a coffee. I'll have a black coffee instead, right? So the horses for courses, right? It's the same objective. You want to lose a bit of weight or be a bit healthy or fitter or whatever it is. The calorie counter, is probably on a lot more focused or condensed pathway. Whereas I'm going to cut out breakfast person's looking for a long-term change, which over time they probably jump on the scales and go, oh, I've lost 5 kilos.
Yeah.
Happy days.
Yeah.
Me personally, I switched to low carbohydrate beer.
You've made your sacrifice. But I think if I look at that as an analogy, Phil, it's very accurate. But I think if I look at people who are healthy and happy, ultimately it comes down to diet, lifestyle, and consistency. Is probably always going to be the word that I see is far more prevalent in successful property investors and people who live a happy and healthy physical lifestyle as well. Yeah. They're typically pretty consistent. They don't try to do things for a very short and radical period of time to get an outcome, and all of a sudden they bounce back to their old habits. If they've got good habits, stick to them. It's not that much more complicated.
Yeah, and the point being that if you if you weigh every meal every day, like
it's just not practical.
It might be practical for some people if they're obsessed with it
for a long period of time.
But if you want a quick way to stop doing something quickly, make it hard to do.
Yeah.
Anyway, maybe property investing is a bit the same. I'm sure there's people that's going to disagree with me on that.
No doubt.
But it's a good analogy.
Then, in turn, you've made your own luck by buying a property which had some owner-occupier appeal, was in a desirable area, had all those fundamentals of no supply, consistent demand in a market that was growing and an economy that was growing. COVID happened. Now, a lot of people, unfortunately, at that early stages of COVID also went the opposite way and said, I've got to get rid of this. And you could have, and I don't doubt that at that time, you might have also had a fleeting moment of saying, we could be in trouble here, we've got to sell Mudgee. But, you hold your...
Do you ever think that in COVID? Ever?
I didn't. It's funny you say it because I know you and I, and anyone who go back to about April 2020 or maybe even March 2020, you and I did a podcast where we talked, and I went really deep into data at that point in time. And I remember going right into it saying, what's likely to happen here? And we looked at the last 5 recessions prior to that. Some of them were expected, some of them were literally within minutes. And we looked at the data, and the following 5 years, property grew. And I know these numbers because I looked through it so many times. The property grew on average, the following 5 years for each of the last 5 recessions from 1980 to COVID grew by 33% on average. And you looked at the reasons why. Why? Because money got cheaper, supply got essentially less available, and ultimately what happened is that the economy had a radical little fluctuation. But the other big thing, which has also played out too, is that property in Australia, almost to the month, every time you see a reduction in value, there is a V-shaped recovery. It's uncanny, and it's typically because there's levers to pull to recover the market. But that's what
overlay the data of property prices and share prices over that period in March and look at the sawtooth difference. But I might be looking at this through rose-tinted glasses. I don't ever remember thinking, oh, God, I've got to sell all my properties. Like, the only time I've ever thought about selling properties because of something happening was when the Premier in Queensland was pretty much going, I'm going to tax everyone on their entire property portfolio if they hold property in Queensland. I actually sat there and went,
this is bad.
This is bad. This is like going, I'm thinking, this is lunacy.
Yeah.
But if this comes in.
I have no control.
I don't like. I know some people with much bigger portfolios.
I know people who sold too. I know a lot of people who sold. And they sold multiple properties unnecessarily, as it turned out.
Yeah. Just because the Premier said, I'm going to tax your whole portfolio. So you might have one $400,000 property in Queensland and you might have $10 million in property outside of it, she's got to tax you on the total amount.
It's funny, Phil. It rewinds my mind.
We fix that, don't worry. But,
absolutely. To 2020, I personally actually just reminded me. I think I bought 6 properties in that year personally, and I know I bought 2 large developments, which I ended up undertaking, both in Sydney at the time, and they ended up being the best returns I've ever achieved in property in a 18-month period of time. And I own most of those properties I developed today. But I remember that was at the time what I did, and I think you did the same thing at that time, Phil, is I got my money ready. I went straight to my bank and my broker, and I said, what can I borrow? What can I borrow? And I remember there was a period of time I went shopping for about 4 months between, I think it was March and about July 2020. I went shopping for everything I could find that I knew had some upside to it.
There you go. Anyway. Countercyclical.
Nerve, and you realise that, hey, residential property in Australia and this current population growth increase that we're going through is extremely, extremely predictable when it comes to the fact of the matter is that we are not building more property in anywhere near the rate that we need to. So you made that decision. You bought Mudgee. Obviously, only 3 or 4 years later, you did the work to say, okay, well, let's not just rest on our laurels here. We're working, we're increasing our income, we've started a family. You could have had, again, all the excuses to say, that's enough. Yep. We don't do this anymore. But you chose to say, okay, we're comfortable being busy. We're comfortable saying it's okay to be busy. It's okay.
Such a mindset thing, right?
Massively. It's everything. It's everything. Like we could all put it, say, too hard basket. That's tomorrow's problem. I'll make that decision in 2024. I'll make it to 2025. There's no doubt people listening to this saying it was my mission to buy a property in 2023. Now it's almost coming to the end, and I shoulda, coulda, woulda again.
Yeah. Is it Chloe or is it the combined partnership with her husband, I imagine? Is it
absolutely her husband Joel? They're both the drivers, so they are equally. She was just available for this interview, but they're both very much equally. And again, another important factor: both on board.
That's important, right?
Both on board, and they're not just super aggressive.
So if you've got a partnership, irrespective of what that looks like, it doesn't matter.
Yeah.
If one person's really hyper into it and one person's not, often doesn't. No.
And if it does, it usually falls apart in some way, shape or form. And someone, if the moment something goes wrong, the person who was the naysayer say, I told you so. If something goes right, they never get the accolades that they deserve for actually being the one who's sort of made all the changes.
Well, that's the other side. We could have done more. You've been holding us back. You wanted to buy a new bike.
Yeah, absolutely. But I hear it actually very regularly. People are like, oh, no, this year we decided to buy a boat because we always wanted to. And then we actually don't. I don't want to name the client, but they know that it was actually the start of COVID. They ended up buying a very expensive boat at the time. It's not someone but it's someone I knew in that at the time they were looking to buy 3 properties and they ended up putting about 500, 600, 700 grand cash into a boat, which was going to be 3 deposits. They had borrowing capacity, and invariably they wanted to do it because they wanted time with their kids, and there was work from home sort of scenario playing out, etc. Lo and behold, they sold that boat 6 months later because they just didn't get to use it. They're like, we don't use it. The boat's too big.
Sold the loss. They probably held the money on it.
Yeah, money was.
But lost 6 months.
Lost 6. They didn't just lose 6 months. They lost about 18 months because by that time they essentially just sort of sold the boat, put the money in the bank, and did nothing. In that 2 years, which between the time we had the first conversation, set the plan of 3 assets, didn't do that, bought a boat, sold the boat, money back in the bank. In that 2 years' time, those markets that were proposed grew by about 30%. And that would have been at about $1.5 million in assets across 3. Yeah. We're talking essentially there was $500,000 lost in 2 years. Let's put it that way.
And was one person more boat than the other person? Or they both boat?
No, one was more boat. The male in that relationship was more boat.
He needed a boat.
Yeah, he wanted a boat because it was his dream, and they had the money freed up. They paid off.
Which is okay.
Yeah, which is fine. Yeah. But they also had a dream of stop work in less than 10 years, and they didn't have the essentially the portfolio or the cash or the assets to achieve that.
Yeah, and this is, again, it's a mindset thing, right? Like a lot of people want everything simultaneously, and usually you can only choose one.
Yeah.
And if you're very lucky, you might be able to choose 2 things. And that is, let's look at the working environment, right? You hear these discussions all the time of saying, I can't afford to buy a house because I can't save a deposit for a house because I'm not getting pay rises. But on the other side, you hear now that I think 50% of all Australians have non-traditional working arrangements now. So that means that they're not a full-time employee.
It's wild.
They're gig economy people. They might have 3 or 4 jobs. They do this, that, and the other. They work when they want because they want the flexibility and it's good for their mental health and all this sort of stuff, right? Which is cool. Choose one,
Yeah.
If you want to be a property investor, means you're going to have to make money to pay for deposits, and you need to make money so you can show a bank that you can afford a mortgage. So choose one. You're probably going to have to choose full-time work, I'm afraid.
Yeah. You have to be boring.
I'm sorry,
You're
but
going to have to be pragmatic.
Unless you can do 3 or 4 gig-type jobs.
And pay tax.
And pay tax. And you might need to work more than 40 hours a week to do that. So often, if you want to be a property investor and create and not have to work in the future, you're probably going to have to choose this one. If you want to travel the world and see things and see the sights, that's cool. You can do that. Choose one.
Yeah.
You know, what I did, I chose one and then I chose the other.
Well, that's it.
That's okay.
That choice after it comes via the choice of the first one. And we've used this analogy a fair bit with builders, saying you can get something done well, done cheap, and done quick.
Yeah.
But you can only choose 2.
Yeah.
You can't have all 3.
You can't have all
And
three.
you know that by only choosing 2, one of those things is going to be sacrificed. And typically it means the outcome you're going to get is not the right one.
Yeah. So, again, it's a mindset thing. So it sounds like Chloe, they worked out what they wanted.
They've got a good balance.
But they haven't compromised too much.
They haven't. But they don't live, I mean, they don't live an extravagant life. They don't have the unnecessary things in life. They're happy. They raise a family.
Yeah.
They do all the things. They work.
And this is like choosing. So they're choosing family and they're choosing property investment, right?
Yeah.
They're not choosing family and property investment and overseas holidays every 6 months. They're not sort of, they're not living a high life with Prada handbags and stuff, right?
Correct.
Like you can't normally, it's hard to get 3.
Yep.
2 normally, but my recommendation, concentrate on 1.
Yeah, start with 1.
Get the 1 first, and you can normally pivot into 2. But anyway.
Okay, to push the envelope a bit if we want to get outcomes that others potentially aren't prepared to essentially do to get the outcomes that we want. And that led to extracting that equity, buying that property in North Brisbane. That property's increased by circa 140, 150 grand. You've preserved that equity. That equity is still sitting there untouched. You've obviously gone back to Mudgee because the equity is still significant in there.
Yes.
And that's led to now the purchase, which was only probably 5-6 months ago in Koodnup. So anyone who's not familiar with Koodnup, a little bit south of the Perth market, more in that Mandurah, bit south of Rockingham region. I actually personally own property in Mandurah myself, which again, not completely dissimilar to Rothwell, where you're probably a little bit further from the CBD of Perth, but for $380,000 of 700 square metres of level land, you are effectively 5 minutes from Robert Bay. You're also literally 5 minutes from the coastline and 100 different beaches you could choose from. You're on a train line directly to the Perth CBD, a highway directly to the Perth CBD. And you've also got a property which, if you did intend to in the future, you could possibly even subdivide and create something more out of it, granny flats, etc. For the listeners, that property, obviously, it's only bought less than 6 months ago. I think we paid $380 for that property. What's the current rent on that property at the moment?
The current rent is $460.
It was $460 actually. We'll get into that because you did tell me off air that this is one of the challenges and buffers in place. And I think the big key for listeners right now is that we're talking about all the things you've done and all the I guess the tough decisions you made to keep building the portfolio. Your tenants have recently done a runner on that property. So you technically now are going through insurance to find new tenants and go through that process. So it's probably worthwhile listeners understanding, saying, what happens if my tenants do a runner? Because it is one of those things I speak about very regularly. It is rare for it to happen, but in your instance, it has happened and there are contingencies in place.
Yes, and I think, look, you don't play in this game without expecting that reality can happen. And I think it just really pushes the importance of having buffers there. And you mentioned earlier about potentially crossing our minds with COVID, having to sell Mudgee. And I think before I jump into the Perth scenario at the moment, having that share portfolio for us was that easy liquidated asset that we could help dig into if we needed to. So we felt quite comfortable during that period because we had the share portfolio there.
Awesome.
But with the Koondanup property, we are only 6 months in. We were told we had great tenants, and I'm sure they're great people. But they have sent an email.
She's very kind, isn't she?
Very kind.
I'm sure they're really nice people.
Yeah,
Sorry, back to the recording. And I'm conscious I'm just stopping the recording. So for people who are on audio, it's probably a little bit harder, but you can tell the difference.
To our real estate management and left the house in a less than desirable state. So, they've left furniture there. We've had to clean out the shed. So not a great outcome. But we had leant into our buffers, and to be honest, it probably is going to cost us about $15,000 all up for that. I think anyone going through this game, I'll call it a game, but it's not really a game, through this stage, this is where insurance becomes a real asset. You need to have the right insurances and check in on that. We check in on that annually anyway. But we are going to be leaning in insurance to claim all that. And obviously timing, again, is not desirable coming into Christmas. Not always easy to get new tenants in, but we are working with our real estate agents. And because we've had those strong buffers there, it hasn't been a big issue for us. And we know we've got the right insurances in place.
Yeah, that's there's probably a couple of really key lessons for me there is that buffers are important irrespective of how good the insurance is, because unfortunately insurance, it comes after the fact. It'll never come immediately when you need it. So the buffers are key. And for anyone who's listening and wonders what a buffer should be or could be, there's different schools of thought certainly out there. From my experience, depending on your incomes and sort of some of your expenditures, we typically find that regardless of your property portfolio, if you quantify how much money you need, whether your properties are positive, negative, neutral, and you've got a larger portfolio, or you only have your home, or you don't have any property in your portfolio, for me, somewhere between that 3 and 6 months of total living expenses to say, if I turn my income off today, how much money do I need to survive? We typically find that somewhere between that 3 and 6 months is sort of your minimum buffer as far as cash buffer. Now, obviously that means that it can be flexible regardless of how you live your life. But that price point of 3 to 6 months is sort of that minimum buffer. If someone's trying to think about how much do I need and what would be a comfortable amount, I've found that over the years of looking through numbers, going through a whole range of different scenarios, that it's a good place for everyone to start, and maybe just do your math on how much money do you actually spend on a 3 month to 6 month basis, and probably then use that as your guiding light, because that's usually going to be a much, much easier way to do some rules. Just touching on insurance, because this is an important one, and it's a very important one, because this is an example and a scenario where insurance could cover this, insurance couldn't cover this. And this is a big part of what we do when we do settle on property, is that we do contact insurance aggregators on our clients' behalf to ideally get a number of different quotes, because those quotes aren't just saying, well, this insurer versus that insurer is going to charge you X or Y for exactly the same insurances. Oils ain't oils when it comes to insurance. And there's things like loss of rent extra. Even loss of rent, it can define whether it's 6 weeks, 10 weeks, 12 weeks, 16 weeks. There can be malicious damage or accidental damage. There can be things like this where we're talking about re-advertising fees. Then you're talking about how much your premium is going to be if you make a claim. All of these things, obviously, they'll dictate the price and the cost of the insurance. But if you don't mind, maybe just sharing some of the top line aspects, because you mentioned, look, this might cost you $15,000. You have buffers in place. However, you've already contacted.
So this insurance bit, Paul, is obviously pretty important. Have you ever seen anyone not be insured and cop it?
I can't say that personally.
Most lenders want it, right? Or they need it.
Which is a good thing, because most lenders want to see the certificate of insurance prior to settling, and with the bank, whoever you're borrowing the money from, as the insured party, as the first mortgagor of that property, to make sure that obviously they're going to get their property covered. For me, that this part is a really key part, and more of my experience over the years is lent towards saying we don't ask the insurance aggregators that we contact prior to settlement when we're trying to arrange correct insurance. We don't say give us the cheapest policy. It's really understanding what do we want included. Things like loss of rent extra is a choice. But obviously, that means you've got to have buffers in place if you choose not to have loss of rent covered. And certain insurers just won't cover loss of rent, whether it's going to be someone doing a runner or whether it's going to be a property burns down and has to be replaced. There's a period of rent that they'll cover that would have otherwise been coming your way, because obviously you've got a mortgage. We have had instances when you buy thousands of properties, you see everything. And over the term, we've seen everything from as simple as someone doing a runner and having to get insurance to cover the clean out of a property, the repainting, recarpeting, loss of rent, and a range of other yard tidy-ups, etc. Making sure that's included in the policy, right through to a house burning down. And a house burning down will be do you have malicious cover? Do you have accidental cover? How did that fire get started? Because that will have to be determined by someone. And if you don't have malicious damage and someone's intentionally tried to burn down your property, whether it's a tenant or someone else, you may or may not be covered for that. So ask these questions. But let's say you are covered for that, then all of a sudden the property has to be demolished. then all of a sudden you've got to know whether the new for old replacement amount is going to be adequate. And let's say it is adequate, you've still got typically probably say 12 months between the time the property was burnt down to when it gets demolished, then it gets replaced. Someone has to pay the mortgage that still exists on that property.
Underinsurance is
huge. And word to the wise, if this is a moment in time for you on your portfolio, pick up the phone to your insurance aggregator or your insurer and go through all these questions. Go through your properties and go through the numbers, because you might be actually really, really surprised into how underinsured you are. And if you want some numbers of some really good insurance brokers, reach out to us. We've got a bunch of aggregators that we can share their names and numbers with, who we know we've worked with over the years, but very important topic permanently.
Cool. There you go. How do people do that?
They could just jump on purepropertyinvestment.com and they can they could probably just give us a call, 1300 98 5428, and our team would be able to put them in touch with some insurance aggregators.
There you go. Cool. All right, back to recording.
If you're an insurer, you go through the process. The idea is that you get all of that essentially reimbursed to you. Out of that, what are the costs, the hard costs for the premium or essentially the excess that you would have to pay for the sake of having all of this covered?
Yeah, look, you've hit the nail on the head with the complexities with the insurance, because whilst we also have to do some paint work and replace carpets and things as part of this. Now, it is, some of that will be, for instance, loss of rent. There is a cap of up to $5,000 on that one. So it's really important for us to turn that around really quickly and get a renter in there. There's two separate claims. You do have the loss of rent, and then also the cleanup and all of those fees as well. So, look, I don't think we're out by too much. I couldn't tell you the exact figure at the end of the day. I do know we've made the decision, and only because my husband has been dealing with the insurance providers on that one for me, which is great. But we have made the decision to not claim the paint job. So we are going to take a hit of about $5,000 there. So that's going to cost us. And that's just because it is a new tenancy, and it's going to be a struggle to prove even though we've been informed, but it's the evidence game, you know.
Exactly. And ingoing inspection reports versus what's wear and tear, etc.
That's
But
right.
I think it's a very real scenario. And I think for those who are thinking it's a nightmare, look, it can be a nightmare if you choose for it to be a nightmare. It certainly could be a nightmare if you don't plan for these things, as far as having buffer and having adequate insurances. But personally speaking, as a large-scale property investor, and have been so for a very long period of time, I can definitely attest to the fact that I've had my fair share of tenants moving out. It hasn't resulted in me selling property. I'm positive of that. And I think even where the juice becomes worth the squeeze, if I'm looking at the numbers, even on the property that we've bought there in Kudna, the property was bought for circa $380,000. I've just actually done a bit of background research on CoreLogic on that property in that market, and I would probably say, as and when that property is freshened up with new tenants, look, it would be freshened up. Likelihood is that the rent will be high fours, if not early fives, by that time. Yes. The reality is that property is probably going to be worth around about $440,000, $460,000, and obviously that was 6 months ago. Now, yes, you've had to tip in some money. No, this wasn't planned. But when you're buying correctly, you're buying in a market that's growing in value. You're buying in a market that will see increased rents amounts. These things will happen. Irregularly, they will happen. But I think you've probably proven the point that if you have the contingencies before they happen, then when these things do invariably happen, you're not left freaking out or holding the bags and thinking, we've just got to get out of this. Because you kind of already said, look, at some stage this will happen. We're planning for it to happen. Ideally, it doesn't happen as soon as it has, but if it does, we're kind of saying, well, this is par for the course. And the more you do it, the more you realize that it kind of comes in a little bit of those waves, and you do get periods of time where it seems to happen every other day. You get a call from your property manager, you have a tenant leave, and then you do get periods, and I can attest again to having dozens of properties where I won't get it, and I'll touch wood right now because I know I'm going to jinx myself, but you do get those 6 to 12 months of zero, and you just get rent comes in, you pay your mortgage and you move on, and growth happens consequently from all of that. But I think it's a really great even keel example as to saying, yes, we've got growth out of the property within 6 months. You've had to deal with probably some of those things you ideally wouldn't deal with in a 10-year time of holding a property.
Yeah, and I suppose, look, we're looking at it whilst it was a risk. It's an opportunity now for us. We are cleaning up the property a little bit more. We're taking the opportunity to redo the carpets, repaint it, spruce it up, and hopefully we will get a better quality tenant in the property. And like you say, add some a little bit more value to that and to the rent that comes into that. So it's hard to paint with tenants in there. So and it did need a paintwork job. So
it's
an
very,
opportunity.
very true. It's very true. And I think probably before we close up on that, the one thing that is worthwhile also noting is that because they were existing tenants, this is a challenge. Sometimes we buy assets with tenants in there. Whilst that's great because you essentially should be getting rent from day one, what you don't get is the ability to do a pre-settlement inspection and look at a property from its warts and all, zero belongings in the property, and actually figure out, okay, at some stage we might need to paint the walls, we might need to redo those carpets. You can get an idea, but when it's full of furniture and people's belongings, it's hard to really understand what it looks like. So probably a word to the wise for any property investors is, yes, it's sometimes a very big win when you can buy a property with existing tenants in place, but it does come with its drawbacks, and that might be that genuinely you can't understand the condition, but also you can't choose the tenants because the tenants are already chosen for you. A lot of the time that's great. Sometimes in this instance, it's worked out not being the best outcome possible, unfortunately.
Yeah. And the other one to lean in on in this one, and it was a risk and we knew that, was this was privately managed before. Yeah.
Which is very common in WA as it turns out. It's a much more common proposition in WA than it is in most other states, privately managed assets.
Yeah. So, for instance, we should have...
I'll just stop it there. One of the reasons why is because agents' fees are a lot more in WA.
They are. They've just got unfortunately, I still haven't had a good explanation from a property management company, but they just seem to have a racket on the whole market. And I think anyone who's a property manager on the East Coast, it's ripe for a shake-up over there.
Yeah. Okay. Let's go back.
Potentially could have challenged the on-time payments and things. So we noticed we're slipping from the start. But because the asset was so affordable from our point of view, being at an entry point of $380,000, it didn't hit our bottom line a significant amount. So it was tolerable. Yeah. And it was easy to get through.
No, for sure. Look, I'm conscious that we obviously could talk about all these different challenges, and now I know there's just so many different bits and pieces. We could definitely lean in on the Mudgee Airbnb scenario and a range of other things as well. But I think for me, probably what would be great to understand for the listeners, and probably just to wrap it up, is where to from here, because obviously you subsequently continue to build the portfolio, and we've made sure that there hasn't been dramatically sideways movements. So obviously there's equity that's building up, there's incomes, there's life, there's all the busyness, etc. And we obviously know that the longer term objective here is to build up this portfolio with the understanding that we want to ideally position you for the environment with income, cash flow that'll suffice. What's the plans from here as far as, given we've just bought this property only 6 months ago, where to and what to at this stage?
Yeah, look, we've thought about that a lot. We are conserving some of our equity in our primary place of residence because we are looking at doing a bit of a knockdown of the back of it and an extension. But to keep our continuing our path forward, we are in the process of converting our super to self-managed super, so we can start to leverage that to purchase our next property, and then hopefully soon after that another property there.
Yeah, absolutely. Absolutely. And I think that's the key there. We talked about diversification, not just into property, certainly into some other aspects, shares being very liquid. You have those available. You can sell them as and when you might need some cash at any given point in time. You've also now obviously got quite a substantial property portfolio. You've got your home, you've got a New South Wales investment, a Queensland investment, a Perth or a WA investment. Now, what that also means is that you start to hit the top end of where your borrowing capacity is from personal names. Now, the conversation we had quite some number of months ago is that saying, well, we're kind of getting close, if not already at the top end of that borrowing capacity for the time being. Superannuation and SMSF is a separate lever that can be pulled even as and when you've reached the maximum of that budget. So obviously they're the conversation you're having, getting some advice from a legal standpoint, understanding the pros and cons, and then ideally continuing to diversify into that looks like it's going to be the next steps. With a decent fund between yourself and Joel, I think what is going to be able to do then now is certainly you've got time on your side, you're going to have leverage on your side, and I'd be extremely confident that I think if we did catch up this time next year, there's no reason why I think we should be talking about the new tenants that are in the Coodnut property, and B, about the SMSF property that's in the portfolio, and ideally some further diversification and building towards that long-term goal.
I'm going to stop it there because we can find out what happens next.
Yeah, absolutely, Matt. Yeah. And I think, look, again, a good example that we started from the very beginning with this conversation with Chloe and also with her husband Joel is that they started, they're continuing to go, even now when they're kind of getting to the point, yes, that there's been all kinds of trial and error, which, as we know, Matt, happens with property when you own it for a long period of time. And now they're getting to the top end of where their borrowing capacity and personal name stands. They're trying to find other avenues and getting the correct strategy, correct advice to look at continuing to build their portfolio. And as you know, mid-30 couple with kids, etc., if they've got one, possibly two more assets in their portfolio, circa value, excluding their principal place of residence of probably around $2.5 million, 20-25 years for that to mature in value, I think they're probably going to be on track for a circa $5 million asset base by the time of retirement, with a relatively modest debt on that and plenty of levers to pull to enjoy what will likely be the opportunity to have a choice for some early retirement. And
again, it's a pretty common story.
Pretty common story. Not hyper complicated there. No. There's nothing in there that people are like, oh, wow, I didn't realize they could do that.
Yeah.
Yeah, it's really, but unfortunately, basic, boring, and just good old-fashioned time and property investing.
Boring is good with property.
Boring is very
Maybe
good.
we should rename this podcast the Boring Property Podcast.
Fantastic. You see, your talent is wasted here in podcast.
Yeah, don't worry. One
brand management, marketing.
Yeah, maybe I'm pretty boring, but no, it's good. That's a Pure Property Podcast with Paul Glossop, episode 4.
Episode 4.
Good.
We're going to get one more out before the end of the year, I think, mate, if we can, but maybe not. We'll see how we can.
See how we go. Well, you can go and you don't need to wait for me to talk to Paul. You can call him up yourself if you want.
You can definitely. 1300 985428 or purepropertyinvestment.com. Also, people can catch up with us on our socials. That's where we pump out a lot of information specific to either property market advice, data, what we're doing at the moment, which markets we're buying in, a lot of these types of updates. So if they go to pure_property, I believe, on Instagram, Facebook, they can like us, follow us, and really get a lot more traction as to the day-to-day machinations. But if you want to catch up and do exactly what we've done there with Chloe and Joel, purepropertyinvestment.com, hit the inquire now button, and they can literally set up a time with me to chat, typically within the week.
All right, there you go. Well, the offer is there. If you haven't started, maybe it's time to start. Anyway, I'll let you make that call. I'll be back again with the Pure Property Podcast with Paul Glossop shortly. Hope you enjoyed that. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.